How does a $1.7 trillion company, with an advertising business that essentially prints money on demand, suddenly become one of the most polarizing, heavily debated stocks on the entire market?
I mean, it really is a genuine puzzle right now.
It really is. Today is April 16, 2026, and if you have been watching the ticker lately, Platforms Meta is an absolute battleground.
Oh, completely. The tug of war is just intense.
Right. We are seeing this grueling falling trend over recent months, massive daily volatility, and yet there's a whole chorus of prominent analysts out there screaming strong buy, calling the stock deeply undervalued.
Yeah, it's enough to give any investor serious financial whiplash.
Exactly. And navigating that whiplash is exactly our mission for this deep dive. We are going to tear apart the income statements and the balance sheets, map out the technical battlefield, and really force the bull versus bear arguments to collide.
So we can finally figure out what is really going on under the hood of this massive transition phase.
Right. But before we get into the heavy numbers, I am throwing down a challenge to everyone listening right now. Hit that like button, subscribe to our YouTube channel, and drop your own thesis in the comments.
Consider it your mandatory admission fee for joining the Deep Dive Club today. We really need to know if you're buying the fear or selling the greed.
Love that. And just to set the ground rules before we pull back the curtain here, we are doing an analytical deep dive. We're using the latest market data to understand the landscape, but this is an objective analysis, not financial advice.
Yeah, absolutely. Not financial advice, just pure data.
So let's establish a baseline so we all know exactly where we stand today. Right now, Meta is trading at $675.40. We're seeing a little bit of intraday strength today, up about 1.95%.
Which is nice, but looking at a single day's movement doesn't really do justice to the turbulence.
No, not at all. To really frame the volatility, you have to look at the massive 52-week range. Just last year, back in April of 2025, this stock was sitting at a punishing low of $479.80.
And then the market just caught fire.
Right. By August 2025, it rocketed to an all-time high of $796.25. And now we are back down. I mean, that is a wild ride for a mega-cap tech stock.
It really is. The sheer scale of that movement is what keeps institutional investors awake at night. When a $1.7 trillion company swings by hundreds of dollars a share in a single year.
It tells you the market is struggling.
Unequivocally. Yeah. The market is struggling to accurately price in a major structural shift. The old models for valuing Meta simply, aren't working anymore.
Which means we need to look at the raw underlying financials to see what's actually funding that shift. Because to understand that stock price, you absolutely have to look at the income statement.
You do. So if we break down the fiscal 2025 annual performance, at first glance, the top line is incredible.
Yeah, they pulled in $200.97 billion in total revenue. That is a massive 22% jump year over year.
Massive. But then you look at the bottom line, the net income, and it actually went backward.
Wait, really? With a 22% revenue jump?
Yeah. It dropped 3% down to $60.46 billion.
Okay, let's unpack this because I look at this and see a huge red flag. It's like owning the most profitable restaurant in town. Every night there's a line out the door. Revenue is through the roof.
But your take-home pay shrinks.
Exactly. Because you are taking every spare dollar, ripping out the kitchen, and spending it all to build this futuristic robotic kitchen in the back.
That robotic kitchen analogy is perfect. To understand why that happened, we have to look really closely at the capital expenditures, or CapEx.
Right, the spending.
Yeah. Meta's operating margin contracted from a high of 43% down to about 40%.
40% is still pretty great, right?
Oh, in the grand scheme of corporate finance, a 40% margin is incredibly robust. But Wall Street is notoriously forward-looking. They react to the trajectory.
And that margin contraction is entirely driven by what, exactly?
A massive $72 billion CapEx spend in 2025, specifically earmarked for AI infrastructure.
Wait, $72 billion?
Just on infrastructure.
Just on infrastructure.
That is like the GDP of a small country being poured into servers. Literally. They are buying tens of thousands of specialized chips, building entirely new data centers, acquiring the immense computational power required to train these next-generation AI models.
Okay, so it's an aggressive expansion cost that directly eats into the net income. But how are they funding it? I mean, are they taking on crazy debt?
No, actually. They aren't leveraging themselves to the brink of bankruptcy at all. The balance sheet remains an absolute fortress.
Let's talk numbers.
Sure. In 2025, Meta generated $43.59 billion in free cash flow.
And just so we're all clear, free cash flow is the actual tangible money left over after they've paid all their operating expenses and those massive expansion costs, right?
Right.
It's the war chest.
Exactly. It's the money they can use to buy back stock, pay dividends, or weather a storm. And furthermore, they have $81.59 billion in total liquidity.
So that's cash equivalents, and marketable securities just sitting there on the books.
Right. And when you weigh that massive liquidity pool against their $58.74 billion in long-term debt, they are in a very comfortable net cash position.
So they're entirely self-funding this massive technological transition.
Yes.
Well, if they have the cash machine churning to fund this futuristic kitchen without taking on dangerous debt, why are we seeing such a massive divergence in how the stock is priced?
That is the million-dollar question.
Right. I'm looking at platforms like Guru Focus and SimplyWall.st, and with Meta's trailing PE ratio sitting at 23.21, accompanied by a tiny dividend yield of 0.31%, they're actually slapping a deeply undervalued label on the stock.
Yeah, they calculate its intrinsic fair value at $765.42.
Which essentially implies it's trading at a 13 to 20% discount right now. I
Yeah.
mean, buying a dominant tech monopoly at a 20% discount seems like an obvious play.
It is an incredibly compelling argument for the bulls. If you purely run the historical cash flow models, buying a company with Meta's margins at a trailing PE of 23 is a textbook value investment.
Okay, but here's where it gets really interesting. Let me jump in here, because when I look at the future guidance, I immediately think we might be looking at a mirage.
How so?
We just talked about the $72 billion they spent in 2025. The guidance for 2026 is projecting CapEx to explode to somewhere between $115 billion and $135 billion.
Yeah, that is a staggering number.
Right. So if they are bleeding that much cash to buy hardware over the next 12 months, how is this not a massive value trap for retail traders?
Oh, that skepticism is entirely warranted, and honestly, it forms the absolute core of the bear thesis.
Because everyday investors see a dropping PE ratio and think it's a bargain.
Exactly. But the bears argue that this exploding CapEx will inevitably suppress earnings growth in the medium term. You cannot spend up to $135 billion without putting a severe dent in your net income.
Which artificially inflates your forward PE ratio.
Bingo. And retail traders often get trapped because they look backward at historical valuations, or they simply see a dip from the all-time highs and they completely ignore the swirling macro risks.
I'm glad you brought up the macro risk, because Meta doesn't operate in a vacuum. What is threatening that $200 billion revenue engine right now?
Well, tariffs are a massive underappreciated concern.
Tariffs. Explain the mechanism there. Why does a tariff on a shipping container matter to a digital ad platform?
Because there is a persistent threat of new, aggressive global tariffs that could heavily squeeze the operational budgets of major international spenders like Temu and Shein.
Ah, okay.
Yeah.
Because they don't just buy a few banner ads.
No, they flood the zone. They spend billions of dollars blanketing Meta's platforms to drive direct consumer sales.
Right. So if new global tariffs suddenly crush their profit margins on the physical goods they're shipping,
The very first thing their CFOs will cut is their massive digital marketing budget. And just like that, Meta loses its biggest whales.
that is a huge downside risk. And beyond the tariff threat, there is the legal exposure.
Yeah, the lawsuits are piling up. Meta is currently facing over 2,400 federal lawsuits regarding platform safety and algorithmic harm to younger users.
Over 2,400 federal lawsuits. We aren't talking about a few minor copyright disputes. That is a dark, heavy cloud of multi-billion-dollar liability hanging over the stock.
It is. So that's the bear cage. Heavily suppressed earnings from exploding CapEx, severe tariff threats, and massive systemic legal liabilities.
But Wall Street isn't stupid. 95% of analysts are currently rating this stock a buy or a strong buy. They must be seeing something in these new AI models that proves this $135 billion spend isn't just a bonfire.
Oh, absolutely. The foundation of the bull case starts with pure scale. Meta has reached an almost unfathomable 3.54 billion daily active users.
Across the whole family of apps.
Yeah. And that number isn't stagnant. It was actually up 8% year over year. But to answer your point about the massive AI spend, the bulls point out that the hardware investment is already yielding tangible results.
How so? Walk me through the mechanics of how buying a server translates to making more money on a social media feed.
It all comes down to ad efficiency, driven by their new Muse Spark AI and their Llama models.
Okay.
Before this deep AI integration, targeting an ad was fairly broad. Now the AI models are so sophisticated they can predict user behavior with alarming accuracy.
So the return on investment for the advertisers skyrockets.
Precisely, because the AI is dramatically better at targeting the right user with the exact right product at the right time. Because the ads are more effective, Meta has been able to increase their overall ad prices by 10% year over year.
Oh, wow. So the AI is directly monetizing the user base at a higher premium.
Exactly.
So before AI, Meta's ad targeting was like a sniper with a very good scope. Now, with Muse Spark AI, it's like a heat-seeking missile that knows exactly what you want to buy before you even type it into your phone.
And advertisers are happily paying that 10% premium because the missile never misses.
But I'd still have to push back here. A 10% bump in ad prices sounds great for a quarterly earnings slide, but does that actually cover a $135 billion hardware bill? The math still feels incredibly lopsided to me.
And that, right there, is the exact friction point dividing the market. The bulls believe the AI efficiency compounds over time, eventually dwarfing the hardware cost.
While the bears believe the hardware costs will outpace the ad revenue growth.
Mm.
Well, if the math feels lopsided to us, I want to know what the people running the calculators inside the building are doing with their own money. If you want to know who is winning a debate, follow the smart money. What are the executives doing right now?
It is giving us a very mixed signal, actually, which perfectly reflects the broader market's hesitation.
What do you mean?
Throughout the first quarter of 2026, we have seen heavy, consistent selling from the highest levels of the C-suite. Specifically, Chief Operating Officer Javier Olivan and Chief Financial Officer Susan Lee have been systematically selling shares.
Taking profits.
Yeah, taking profits at price levels between $605 and $645.
Now, when the chief financial officer, the person with the most intimate knowledge of the company's ledger, starts selling shares, everyday investors tend to panic.
They do, but we need to be precise here. These aren't executives logging into a brokerage account and dumping shares on a whim.
Right. They are using Rule 10b 5-1 trading plans, correct?
Correct. This is a crucial mechanism to understand. It means these executives set up a legally binding schedule months, sometimes years, in advance.
So they dictate that a specific number of shares will be sold at specific price targets.
Completely, regardless of any non-public information they might possess at the time of the sale. It's just a structured way for them to take profits, pay taxes, and diversify their personal wealth.
Without running afoul of insider trading laws. So it's not necessarily a signal that they think the ship is sinking. They aren't fleeing.
No, not at all. But they are absolutely locking in their wealth and taking chips off the table at that $600 to $640 level. They see that as a fair price to cash out.
What about the institutions? The major funds that move markets?
We see a different strategy there. Institutional buyers have been systematically accumulating shares down near the 52-week lows.
So whenever the stock dips toward that $500 range, the big money steps in to scoop it up.
Yeah, establishing massive long-term positions. They view the dips as a buying opportunity. However, I should note a recent development. ARK Invest, which has been a major proponent of the AI revolution, did recently reduce their meta positions slightly.
Really? That's interesting.
Yeah. They framed it strictly as portfolio risk management, taking some profits to rebalance, but they did trim it.
So we have this exact hesitation. Executives taking scheduled profits, institutions buying the deep dips, but funds like ARK trimming their sales.
Yeah.
That has to leave a physical footprint on the stock's chart.
Oh, it absolutely does.
When you have this much fundamental uncertainty, the technicals become a chaotic battleground. How is this tug-of-war actually manifesting on the charts right now?
Well, the stock is currently fighting its way through a recovery phase. Remember, it hit a painful local bottom of $525 just recently, back on March 21.
Yeah, that was a rough week.
From that capitulation point, the short-term trend has definitively turned bullish, even though the longer-term macro trend over the last year is still best described as choppy consolidation.
Okay, so break down the battlefield for the listener. Where are the trenches?
For immediate support, the floor the stock is currently bouncing off of, we are looking at S1, which is $634.05.
Why is that specific level important?
Because it was a previous ceiling of resistance that the stock broke through, and now it has flipped to become a supportive floor. If that floor breaks, there is a deeper support level, S2, at $573.01.
And for anyone who glazes over a technical jargon, that $573 level is a Fibonacci pivot. We're basically talking about mathematical ratios that algorithmic traders use to predict where a falling stock might finally find a psychological floor.
Right. That is exactly right. It's almost a self-fulfilling prophecy driven by algorithmic trading programs.
Okay, and on the upside?
The immediate resistance, R1, is sitting at $681.70, with an immediate target, R2, of $706 if it breaks out.
So let me visualize this because the psychology behind these numbers is fascinating. The stock is trading above its shorter-term 50-day moving average of $629.75,
Right.
which is acting like a trampoline bouncing the price upward. But as it jumps up, it keeps hitting its head against a brick ceiling. That 200-day moving average cluster at $681.71.
A brick ceiling of break-even sellers is the perfect way to understand that resistance. If you bought near the top last year and rode this stock all the way down, the moment it gets back to your break-even point near $680.
You are selling just to escape the pain.
Exactly. That creates a massive wall of supply. So the stock is trapped between the trampoline and the ceiling.
Is there any sign of a breakout?
Actually, yes. The momentum indicator suggests the buyers might have enough strength to break through. On April 7, the MACD, the moving average convergence divergence, crossed over and turned positive.
Oh, nice. So that's a classic signal that the short-term momentum has shifted aggressively toward the bulls.
It is. But no technical indicator exists in a vacuum. There has to be a catch.
There's always a catch. What is it?
While the MACD shows strong upward momentum, another key indicator, the RSI, the Relative Strength Index, is currently sitting at 66.86.
And when the RSI creeps up towards 70, that's a classic signal to technical traders that an asset is becoming overbought.
Meaning it has moved upward too aggressively without a break, and it's running out of immediate, fresh buyers.
It's like sprinting up a steep hill.
Yeah.
Eventually, you have to stop and catch your breath before you can keep climbing.
Exactly. Because of that RSI level, traders should watch out for a minor short-term weakness or pullback as the market digests the recent gains.
Even with the threat of a minor technical pullback, the broader consensus on Wall Street remains overwhelmingly, almost aggressively, positive.
Yeah, as we mentioned earlier, 95% of analysts rate Meta a buy or a strong buy.
They have an average 12-month price target of $837.72, which would be a new all-time high. And there are aggressive bulls out there eyeing $1,000 or more per share.
It really highlights how deeply the institutional market believes in the long-term payoff of this AI transition. They're perfectly willing to look past the short-term sticker shock of a $135 billion CapEx bill.
Because they believe the revenue efficiency at the end of the tunnel is unparalleled. So we have piled a massive amount of fundamental, technical, and insider data on the table. If you are listening to this right now, trying to filter out the noise and make sense of this battleground stock, how do we synthesize all of this? What is the actual outlook?
If we break it down into timeframes, it becomes much clearer. The short-term outlook, meaning the next 2 weeks, is that this bullish technical momentum will likely continue to test that $680 to $700 resistance zone.
Basically, the market is currently in a phase of pre-positioning.
Right. Major funds are getting their bets in place ahead of the highly anticipated Q1 2026 earnings call, which is scheduled for April 29.
Okay, and for the medium term, looking out through the volatile summer and into the rest of 2026.
The medium term is entirely a binary outcome. It all rests on management's ability to definitively prove that this staggering hardware spend will actually translate into higher operating income.
So, on April 29, Mark Zuckerberg and Susan Lai need to step up to the microphone and report that Q1 revenue confidently hits their guidance of $53.5 to $56.5 billion.
And more importantly, they need to show that the operating margins have stabilized despite the spending. If they do that, a summer retest of that 796 all-time high is entirely possible.
The market will heavily reward the proof of concept. But if margins slip further,
The punishment will be severe.
it always comes down to the bottom line. Wall Street loves the AI story right now. They love the narrative of the futuristic robotic kitchen that works with perfect efficiency, but eventually you have to serve the food and the customers have to pay the bill.
That's the reality of the market.
Which brings us right back to where we started. We are looking at a $1.7 trillion company that is printing money, but spending it just as fast to rip out and rebuild its entire technological foundation. I want to leave you with a final, slightly provocative thought to mull over, something that goes beyond the quarterly earnings reports.
I love these. Let's hear it.
If Meta is betting up to $135 billion on artificial intelligence this year alone, assuming the technology will scale infinitely, what happens to that massive valuation if those Llama models and the Muse Spark AI hit a development plateau?
Oh, wow.
Right. We assume technology always gets exponentially better, but what if they hit a wall? Are we looking at the brilliant foundation of the next definitive tech empire, or are we witnessing the most expensive, devastating science project in corporate history?
That really is the trillion-dollar question driving this entire tug of war.
It really is. Thank you for joining us on this deep dive into meta platforms. Don't forget to drop your thoughts on that exact plateau question down in the YouTube comments. We read all of them. Until next time, keep questioning the consensus and stay curious.